Let's say that you were given $10,000. Now, when you first get this money, you may be experiencing a lot of feelings of joy. That's him happy. And after you bask in the glory of having $10,000 more dollars, what do you do now? Where do you put all that money? See, Johnny Cash here is about to find out about the fractional banking reserve system, and he will learn about banks and credit unions throughout this video. So you have to come to a decision of what to do with that money. So where would you take that money? You would have to make an informed decision to make a smart choice about where you would take your money, and that's what you're about to do. When you first look for a bank, it might be surprising to see how many that there are. It may knock you off your feet. But with some smart thinking, you can narrow the choices way down. How can we narrow down the banks that we are choosing? Well, for example, you could use region to decide which bank you would want. There are national banks and there are local banks that you can use. For example, you can choose a bank like KeyBank, which is a national bank, or TD Bank for your bank, or you could go with something more Maine-based like Bangor Savings or Camden National. For the sake of example, let's just say that you picked KeyBank as your main bank that you're going to go with. But you may be wondering, isn't there another thing out there other than banks? And you would be right. This would be a credit union. And I will help distinguish the difference between a credit union and a bank. Now, a credit union offers lower fees and better interest rates, but they have less options. They are also a non-profit organization, and they require you to be a member of some kind and have something similar into all what the members have. For a bank, it is a profitable organization and has more options. There are also more banks, and you don't need to have something in common with other bankers to be part of it. But safely, you can say that both banks and credit unions are safe and reliable, so whether you use a credit union or a bank, you are sure to have your money safe and secure. So let's say you finally decide that you're going to choose a bank, and for example, let's use KeyBank. Now, why might somebody as yourself choose KeyBank as your bank? A neat thing about KeyBank is that it allows its members to have more benefits the more accounts you have with it. So the closer you are with KeyBank, the more benefits you get and the more money you will earn. Now let's say that this guy is a KeyBank member and that this person is a TD Bank member. Both banks offer a $3 ATM fee on out-of-system ATMs. KeyBank also has no monthly maintenance charge, while TD Bank has a $15 waivable monthly fee. You must maintain a $100 minimum to waive that fee, while KeyBank does not have to do that. KeyBank offers an overdraft protection, while TD Bank charges $35 for each item they pay for. So if this guy paid for two $10 items, he would have to pay $70 if they were overdrafted. If you open a checking account and a savings account, you do not have to pay a monthly service fee, and you would make 0.01 of your total amount in your savings account. So, yeah. Now, for argument's sake, let's say that the Federal Reserve interest was 0.15. So that means if you transferred $10,000 into a bank, that means they will have to save $1,500, but that means they can loan out $8,500 to another person. If that person loans out $8,500, then to another bank, then that bank makes $1,275, while that one can loan out $8,500, and this keeps on going. Now, technically, even though the bank is only holding about 0.15% of your money, technically you still have all 10,000 in your bank, because most of the money in the U.S. Banking system is just numbers. So all this may not be in the bank, but it is technically still part of your wealth. And remember, multiple people are loaning to banks. So this means you can still withdraw some of your money even though not all of it is in that bank. So let's say that all of your money is the overall money supply. So you would have 10,000. Now, in order to see how much profit the Federal Reserve banking system would make, you would have to divide it by the Federal Reserve, which in our case is 0.15 or 15%. So we'd have to divide $10,000, which is the total amount of supply, divided by the percentage, and you would get the total amount of money made by the system. So we would have $66,666.60 all from you, and multiple people are doing this. So this creates more money even though there is no actually newly printed dollar bills. Now, since earlier in the video we said that you would choose KeyBank, let's look at the choices we have as checking accounts. So we have a checking account that has no monthly maintenance fee in simple checking, but you will not earn interest from it. In this one you will, but there will be an $18 waivable monthly maintenance fee. But waivable means you can get rid of it, but you will earn interest from it. And this one has a $25 one, but you also get interest. There's also savings account, which usually earn interest all the time, and there are certificates of deposit. You have home loans and mortgages. You could get like a mortgage on your home or like a loan for your home, or you could get one for your car or anything like that. You can get a credit card. You could get investing in insurance. These are all lines that KeyBank offers. With a savings account, you would get an annual percentage yield. This is the amount of money you would earn in a year. And with something like a loan, you would get a annual percentage return, and this is how much money you would have to pay extra back to the bank for, like, say you borrowed $10,000, so instead of you giving it to the bank gives it to you. You would have to probably pay around $1,500 or something like that back to them extra. And the good thing about checking accounts is that they have a ton of liquidity. So that means even though you don't have the dollars right there, a checking account, you could get a debit card for it. And then all this money, even though there's no physical backing, you wouldn't need it. You would just need to use your debit card, and it would transfer right from your account into the register. So you wouldn't have to take out all that money and you wouldn't have to carry it around. So it's very easily transferable. You wouldn't have to go through a bunch of trading in order to buy something. Annual percentage yield and annual percentage return is both based off interest. Interest is the amount of money you earn. Like I said, if you had $10,000, you would be able to get an interest of 0.15 with the Federal Reserve banking system. So interest would be like the extra money added. Say instead of $10,000, it would be $11,500 with interest. It would be the extra percentage of money that you owe or that you earn. So the Federal Reserve can also impact how much you make. If the Federal Reserve was low, you would earn more interest because you would be dividing by a smaller percentage. So if you had $100 divided by a 0.01 interest rate, you would be making $10,000. If you had a high Federal Reserve, 100 divided by 0.1 is only $1,000. So notice how there's a 10 times different in just that much percentage. That is how much you would make different. So if the Federal Reserve government would want to lower interest rate and constrict money flow, they would make the Federal Reserve higher. And if they want to increase money flow, they would have to make the Federal Reserve percentage lower.